2025 isn't just another year in investing. It's a turning point. The global economy is shifting, inflation is reshaping markets, new technologies are rewriting the rules, and investors are asking one question: where should I put my money to grow, protect, and secure my future? The truth is, there's no single answer, but there are strategies, proven, time-tested, and future-ready, that when combined can create a portfolio built not just to survive, but to thrive. In this video, we're breaking down the top 10 investment strategies for 2025. Each one brings something unique: growth, stability, income, protection, or innovation. Together, they form a roadmap for anyone who wants to take control of their financial future. We'll go deep into each strategy, step by step, showing you how to apply them in real life, with practical allocations, expert insights, and the big trends driving the markets. So, if you're ready to build not just an investment plan but a financial fortress for 2025 and beyond, let's begin. With strategy number 1. Strategy number 1. Diversified equity portfolios. Equities or stocks have been a cornerstone of wealth creation for decades. They offer the potential for high returns, especially over the long term. But here's a reality check. Putting all your money into one company or sector is risky. Market volatility, economic shifts, or even sector-specific downturns can dramatically affect your portfolio. That's why diversification is essential. In 2025, consider spreading your investments across multiple sectors. For example, technology, AI, cloud computing, cybersecurity, sectors with high growth potential, healthcare, pharmaceuticals, biotech, and medical devices. The aging population and healthcare innovation continue to drive long-term demand. Renewable energy, solar, wind, and battery technology. As governments and corporations commit to sustainable energy, this sector is expected to grow. Consumer goods. Companies producing essential goods tend to be resilient during economic slowdowns. Diversification is not just about spreading risk, it's about balancing growth and stability. According to BlackRock's 2025 Outlook, carefully diversified equity portfolios can outperform narrowly focused investments while mitigating extreme losses during market corrections. Now, when building a diversified equity portfolio, focus on quality over quantity. Look for companies with strong earnings growth, low to moderate debt levels, consistent cash flow, clear long-term strategies. By combining high-growth opportunities with more stable, reliable companies, you create a portfolio capable of capturing market upside while protecting against downside risks. Remember, diversification is not a one-time effort. Review your portfolio regularly and rebalance to maintain your desired exposure across sectors. In 2025, with market volatility expected in some areas, this discipline could make a significant difference in overall returns. Strategy number 2. Exchange-traded funds, ETFs. If picking individual stocks seems overwhelming or time-consuming, ETFs, or exchange-traded funds, might be the perfect solution. ETFs are essentially baskets of stocks or other assets that trade on the stock market just like a single stock. Why are ETFs particularly attractive for 2025? First, they provide instant diversification. Instead of buying 10 or 20 individual stocks, you can buy a single ETF and gain exposure to an entire sector, industry, or theme. This not only spreads risk but also simplifies portfolio management. Second, thematic ETFs are on the rise. Investors are increasingly looking for targeted exposure to high-growth areas such as artificial intelligence and robotics, biotechnology and healthcare innovation, renewable energy, and ESG-focused companies. These ETFs allow investors to align with emerging trends without the risk of picking individual winners and losers. Third, ETFs are generally more tax-efficient than traditional mutual funds, meaning you keep more of your gains. They're also highly liquid, allowing you to buy and sell easily, which is essential in a fast-moving market. When selecting ETFs, don't just chase last year's performance. Look for low expense ratios, strong historical performance relative to peers, a clear, well-defined investment focus, experienced fund management. It's also a good idea to mix broad market ETFs, like total U.S. stock market or S&P 500 funds, with thematic ETFs to balance growth and stability. For example, you might allocate 60% in broad market ETFs for steady growth, 40% in thematic ETFs for higher upside potential. This combination helps capture market growth while taking advantage of emerging sectors shaping the future economy. Both diversified equity portfolios and ETFs share one fundamental principle. Don't put all your eggs in one basket. In 2025, economic uncertainty, inflation pressures, and global market shifts mean that strategic allocation is more important than ever. Regularly monitor your portfolio and rebalance if one sector becomes overweight. Keep an eye on market trends but avoid reacting to short-term noise. Focus on companies and funds with strong fundamentals and long-term growth potential. By combining equities and ETFs strategically, you build a foundation that can weather volatility and benefit from multiple growth opportunities simultaneously. This is not about quick wins. It's about creating a resilient investment strategy that grows over time, maximizes returns, and reduces unnecessary risk. Strategy number 3. Precious metals. Precious metals, especially gold and silver, have long been used as a hedge against inflation, currency fluctuations, and economic uncertainty. While stocks and ETFs offer growth, metals provide stability and protection. In 2025, several factors make precious metals particularly appealing. 1. Inflation protection. With global inflation trends, gold historically maintains its value while other assets may lose purchasing power. 2. Economic uncertainty. Geopolitical tensions or market corrections can hit equities and crypto, but precious metals usually hold steady. 3. Portfolio diversification. Including metals reduces overall portfolio risk because their performance often moves independently from stocks. Experts like Jeffrey Gundlach, CEO of DoubleLine Capital, predict that gold could surpass $4,000 per ounce if the US dollar weakens and inflation remains elevated. Silver, while more volatile, also offers strong long-term growth potential. Now, how should you invest? Physical metals, gold bars, coins, or bullion stored securely. ETFs, gold and silver ETFs provide exposure without the hassle of physical storage. Mining stocks, companies that mine gold and silver can offer leveraged returns, though they come with higher risk. A practical tip: allocate 5 to 15% of your portfolio to precious metals, depending on your risk tolerance. This portion acts as a safety net while the rest of your investments chase growth. Strategy number 4, real estate investment trusts, or REITs. Next up, let's talk about real estate investment trusts, or REITs. If you've ever wanted to invest in real estate but didn't want to deal with tenants, mortgages, or property maintenance, REITs are the solution. REITs are companies that own, operate, or finance income-producing real estate. By buying shares in a REIT, you can earn income from rents or property sales without owning physical property. In 2025, certain sectors of REITs are particularly attractive. Data centers. With cloud computing and AI growth, demand for data storage facilities is skyrocketing. Logistics and warehousing. E-commerce continues to boom, increasing the need for warehouses and distribution centers. Healthcare and senior living. An aging population ensures steady demand for healthcare facilities and residential care. Residential REITs. Urban housing and rental demand remain strong, especially in cities with limited supply. Why consider REITs for your portfolio? 1. Regular income. REITs pay out a large portion of their profits as dividends, offering a reliable income stream. 2. Diversification. REITs behave differently than stocks and bonds, providing additional portfolio balance. 3. Growth potential. Well-managed REITs in high-demand sectors can appreciate significantly over time. When choosing REITs, focus on sector trends. Know which property types are poised for growth management quality. Experienced teams manage properties efficiently. Dividend track record. Consistent payouts indicate stability. A practical approach: consider allocating 10 to 20% of your investment portfolio to REITs. Combined with equities, ETFs, and precious metals, this creates a well-rounded, diversified portfolio that balances income, growth, and risk protection. By now, you've seen that investing isn't just about chasing returns, it's about creating balance. Precious metals provide stability, REITs provide income and growth, and equities and ETFs provide long-term appreciation. The key principle here is strategic allocation. Each asset class plays a unique role. Equities and ETFs, growth, precious metals, protection, REITs, income plus diversification. A well-diversified portfolio across these assets can withstand volatility, capture opportunities, and give you peace of mind in uncertain times. Remember, consistent review, thoughtful allocation, and focusing on quality are more important than chasing short-term trends. Strategy number 5. Global diversification. Limiting your investments to one country exposes you to unnecessary risk. Economic cycles, political changes, and currency fluctuations vary across regions, so spreading your investments globally can improve returns and reduce volatility. In 2025, emerging markets like Southeast Asia, India, and parts of Eastern Europe are showing strong growth potential. Rapid industrialization, technological adoption, and rising middle-class populations drive consumer demand and corporate profits. Developed markets, such as the US, Canada, and Western Europe, provide stability and access to mature industries. By combining emerging and developed markets, you create a portfolio that balances high growth potential with lower risk. A practical approach is using international ETFs or global mutual funds. These allow you to invest across dozens of countries without the complexity of opening foreign accounts or navigating local regulations. Experts recommend allocating 20 to 30% of your equity investments globally. Within this allocation, consider a mix: 60% in developed markets for stability, 40% in emerging markets for higher growth potential. Currency diversification also matters. Investing in assets denominated in multiple currencies can act as a hedge if your home currency weakens. Over the long term, global diversification is a powerful way to capture growth while shielding your portfolio from regional downturns. Strategy number 6. Sustainable and impact investing. Sustainable and impact investing is no longer just a trend. It's becoming mainstream. Investors are seeking companies that prioritize environmental, social, and governance ESG factors because these companies often demonstrate long-term resilience and profitability. Key sectors gaining attention in 2025 include renewable energy, solar, wind, and battery storage technologies, clean technology, electric vehicles, green infrastructure, and water purification. Social enterprises, companies that create measurable social impact while remaining profitable. Research shows that ESG-focused companies tend to outperform non-ESG peers over time. By aligning investments with sustainable principles, you can achieve both financial returns and positive impact. Ways to invest: ESG ETFs, or mutual funds, provides exposure to a diversified group of sustainable companies. Individual ESG stocks invest in companies with strong sustainability practices. Green bonds, fixed income options funding environmentally friendly projects. A strategic allocation could be 10 to 15% of your equity portfolio. The goal is not to replace your core growth investments, but to enhance long-term returns while supporting responsible business practices. Sustainable investing also mitigates long-term regulatory and reputational risks. As governments enforce stricter environmental standards, companies ignoring ESG principles may face fines, penalties, or declining market share, while sustainable leaders thrive. This strategy combines financial performance with purpose, a combination increasingly valued by both investors and the broader market. Global diversification and sustainable investing complement each other. By investing globally, you reduce region-specific risks and tap into new growth opportunities. By incorporating ESG-focused assets, you position your portfolio to benefit from long-term trends toward sustainability and responsible business practices. Together, these strategies add balance, resilience, and forward-looking growth potential to your portfolio, setting a strong foundation for the remaining strategies we will explore. Strategy number 7. AI-driven investing, 00 to 630. Visual. Futuristic dashboard with stock graphs moving in real time, AI algorithms analyzing data streams. Narrator. Artificial intelligence is transforming the way we invest. Instead of relying solely on human judgment, AI can analyze millions of data points across markets in seconds, spotting patterns and opportunities that even the most skilled fund managers could miss. AI-driven investing uses algorithms to assess stock trends, predict risks, and optimize portfolios. In 2025, it's not about replacing human investors but augmenting their decision-making. Here's why AI-driven investing is gaining ground. 1. Speed and scale. AI processes vast datasets, earnings reports, economic indicators, social media sentiment, and even geopolitical news in real time. 2. Risk management. Algorithms can detect early warning signs of volatility, allowing portfolios to adjust before losses deepen. 3. Personalization. AI-driven platforms tailor portfolios to individual goals, whether it's retirement, passive income, or aggressive growth. Examples include robo-advisors like Betterment, Wealthfront, and Vanguard's AI-driven models, as well as hedge funds using proprietary AI tools to gain an edge. But AI is not foolproof. Algorithms can be biased by the data they're trained on, and they sometimes overreact to short-term fluctuations. The key is to use AI as a tool for efficiency, not as the sole decision-maker. For everyday investors, AI-driven ETFs or platforms are an accessible entry point. These funds use algorithmic strategies to adjust holdings automatically. Allocating even 5 to 10% of your portfolio to AI-driven products can enhance returns while reducing human error. The future of investing is human intuition backed by machine intelligence, and those who embrace this hybrid approach will likely have an advantage. Strategy number 8. Fixed income securities with inflation protection. While equities and AI-driven strategies offer growth, stability is equally important. That's where fixed income securities, particularly those with inflation protection, come in. Traditional bonds provide steady income, but inflation erodes their real value over time. To counter this, instruments like Treasury inflation-protected securities, TIPS, inflation-linked bonds, and high-quality corporate bonds play a vital role in a balanced portfolio. Why they matter in 2025. 1. Inflation concerns. Even moderate inflation can reduce purchasing power, making inflation-linked bonds attractive. 2. Predictable income. Fixed income assets provide reliable interest payments, ideal for stability seekers. 3. Capital preservation. Bonds issued by governments or top corporations carry lower risk compared to equities. TIPS, for example, adjust their principal value based on changes in the Consumer Price Index. That means as inflation rises, both your bond's value and interest payments increase. For diversification, you can also consider municipal bonds, tax advantages, especially useful for high-income investors, corporate bonds, higher yields but balance with credit risk. Bond ETFs simplify exposure by holding a basket of bonds. The recommended allocation depends on age and risk tolerance. Younger investors might allocate 10 to 20% to fixed income for balance, while conservative investors or retirees could hold 40 to 50%. The point isn't to chase high returns here, it's to create a safety net. When equities face turbulence, fixed income securities smooth the ride, ensuring your portfolio doesn't collapse under pressure. AI-driven investing offers innovation and agility, while inflation-protected bonds provide stability and security. Together, they create a portfolio that is both forward-looking and grounded. This balance between technology-powered growth and traditional safety nets embodies the essence of smart investing in 2025. Adapt to the future without abandoning proven fundamentals. Strategy number 9. Peer-to-peer lending. Peer-to-peer lending, or P2P lending, has emerged as a modern way to generate returns outside of traditional banks. Instead of financial institutions acting as middlemen, investors lend money directly to individuals or small businesses through online platforms. In return, investors earn interest, often significantly higher than what a savings account or even some bonds can provide. Why it's relevant in 2025. 1. Alternative income source. As interest rates fluctuate, P2P lending offers consistent returns in the 5 to 12% range depending on risk level. 2. Accessibility. Platforms like Lending Club, Prosper, and Upstart make it easy for investors to participate with relatively low minimums. 3. Diversification. P. 2. P lending is not tied directly to stock or bond markets, providing another layer of diversification. However, P2P comes with risks. Borrowers may default on loans. Returns depend heavily on platform stability and economic conditions. To mitigate risks, spread investments across dozens or hundreds of loans, rather than lending large amounts to just a few. Choose platforms with strong vetting processes. Limit allocation to 5 to 10% of your total portfolio, keeping it as a high-yield but higher-risk slice. For investors comfortable with moderate risk, P2P lending can be a valuable way to generate income while supporting small businesses and individuals directly. Strategy number 10. Emergency Fund. The final strategy might not sound glamorous, but it's absolutely critical. Building an emergency fund. An emergency fund is cash set aside for unexpected events. Job loss, medical bills, car repairs, or sudden expenses. While it doesn't generate high returns, it provides liquidity and peace of mind. Why it matters in 2025: economic uncertainty, inflation, and job market shifts mean surprises are inevitable. Without an emergency fund, investors are often forced to sell stocks or assets at the worst possible time. Having cash reserves allows you to stick to your investment strategy without panic. How much should you keep? A common rule: 3 to 6 months of essential living expenses. For freelancers or those with irregular income, 6 to 12 months is safer. Where to keep it? High-yield savings accounts, currently offering 3 to 5% interest in the U.S. Money market funds for slightly higher yields while maintaining liquidity. Avoid tying it up in long-term investments. Accessibility is the priority. Think of your emergency fund as the foundation of your financial house. Without it, even the strongest portfolio can crumble under pressure. With it, every other strategy we've discussed becomes far more effective, because you won't be forced to pull money from investments prematurely. We've explored 10 strategies, each one designed to strengthen your portfolio in its own way. Equities and ETFs fuel your growth. Precious metals and bonds guard your wealth. REITs and P2P lending generate steady income. Global diversification and sustainable investing keep you future-ready. AI-driven tools give you speed and insight. And the emergency fund? It's the anchor that holds everything steady when life throws surprises your way. The truth about investing in 2025 is this: there's no magic bullet, but there is a formula. And it's balance. Balance between risk and safety, between innovation and tradition, between chasing returns and protecting what you've already built. Your financial future doesn't have to be uncertain. With the right mix of these strategies, you can create a portfolio that's resilient, adaptable, and built to thrive no matter what the markets or the world throw your way. So now the choice is yours. Will you let 2025 happen to you, or will you take control of it? Because the best time to prepare was yesterday. The second best time is today.